Welcome to another episode of Delta Investments Deep Dive, where we go in depth and unpack our research on specific stocks and discuss the risks. I'm Marcus.
And I'm Sloan.
And setting the stage for you all today, it is Wednesday, March 11th, 2026. If you're listening to this, you're probably trying to figure out the massive tectonic shifts happening in the overarching topic we're tearing down today.
Right, the global semiconductor industry.
Exactly. I mean, we are living through this completely historic AI-driven super cycle right now. It's really everywhere you look. Global sales are just shattering records, and the total market value of the sector is violently accelerating toward this $1 trillion milestone.
Which is just a number that, well, it's so large it almost loses all meaning for the human brain.
Yeah, $1 trillion. It's absurd.
It is. And when you look at your portfolio or you're reading these daily financial newsletters, it's so easy to get blinded by those top-line macro headlines. You see the massive valuations of the legacy tech giants sitting at the very top of the food chain, and the instinct is to just assume the whole story begins and ends right there.
But it doesn't. That's why we're doing this deep dive. Because you already know the household names. You see the headlines about, massive language models and these billion-dollar data centers.
Those shiny objects.
Right, the shiny objects. But what you actually want to know today is where the real value lies hidden beneath those obvious surface-level narratives. You want to know who is physically building the pipes, the internal wiring that keeps this entire new world from literally melting down.
Because it is a ground-up re-architecting of the infrastructure.
Exactly. So our mission today is to tear down the financials, deconstruct the strategic pivots, and translate the very complex technological breakthroughs of one specific company at the beating heart of this shift. And that company is Navitas Semiconductor, trading under the ticker NVTS.
And Navitas is just a fascinating real-world case study right now. They're navigating what management calls a strategic pivot. But, in corporate speak, that usually means a minor course correction.
Like tweaking a marketing budget.
Right, exactly. But here, no, this is a massive, highly painful, but potentially incredibly lucrative total transformation of their business model. They are actively walking away from the products that originally made them successful.
Which is always a huge gamble.
It is. But to understand if that gamble will pay off, we really have to strip this macro environment down to the studs first.
Yeah.
We need to look at the physical and economic forces rewriting the rules of the whole ecosystem.
Yeah, let's start with the sheer physics of what's happening inside these data centers right now, because the reality is mind-blowing. This whole surge is fueled by just massive, unprecedented capital expenditure in AI infrastructure.
And you see that reflected in the revenue mix globally. High-performance chips, the actual silicon brains processing these data sets, they now account for nearly half of all industry revenue.
Which is a huge shift. But I think what people struggle with is the why. Like, I get that AI is power-hungry, sure. But why is it so fundamentally different from the cloud computing we had, say, 5 years ago? Why are the physical buildings struggling to keep up?
The easiest way to visualize it is to compare a traditional cloud server to generative AI training. Traditional cloud, the server is hosting a corporate website or running legacy email software. It operates on a very predictable, low-intensity power curve. You send a request, the server fetches the data, and then it immediately drops back down to a low-power idle state. Generative AI fundamentally breaks that model.
Because it never stops thinking.
Right. Training a massive neural network requires running thousands of advanced GPUs simultaneously at absolute peak capacity. We're talking weeks or months without a single break. You aren't just retrieving data anymore. You are brute forcing complex mathematical probability on a massive scale.
So the electricity required to sustain that is, wow, it's staggering. I want to throw an analogy in here because I think it perfectly frames the investment thesis for you today. Think about NVIDIA. They are out there building the ultimate, most advanced race car engine the world has ever seen. It's a beautiful piece of engineering.
The best in the world.
But the broader industry is waking up to this terrifying realization. You cannot just drop a 1,000-horsepower rocket engine into a standard economy car chassis. If you do that, the whole thing just shakes itself apart and melts. To actually run this AI engine, the industry desperately needs to rebuild the fuel pumps, upgrade the wiring, and basically repave the whole racetrack.
And the concept of melting it's really not an exaggeration when you look at the thermal dynamics on data center floors today.
Not at all.
The legacy architecture was built for a totally different era. If you walk into a traditional data center, the server racks are designed around a 54-volt direct current power architecture. And for standard CPUs, 54 volts was fine.
It did the job.
It did. But today, with next-generation platforms like Blackwell and Rubin from NVIDIA, the power density demands are shattering those old limits. We are now seeing individual server racks scaling toward 1 megawatt of continuous power consumption.
Let's just pause there and translate that. 1 megawatt per rack. A megawatt is roughly enough electricity to power several hundred typical homes. And the industry is trying to squeeze the electrical draw of a small suburban neighborhood into a single metal cabinet sitting on a floor.
It's an engineering nightmare.
It really is. So why can't they just plug more of the old 54-volt racks into the wall? Why does the whole architecture have to change?
It comes down to a bottleneck of pure physics. When you try to push a massive amount of power through a low-voltage system like 54 volts, the laws of electricity dictate you have to push an incredibly high amount of current. And in electrical engineering, current is the enemy of efficiency.
Because current generates heat.
Exactly. Current generates heat. The higher the current, the thicker the physical copper cables need to be, and the more energy you lose to the surrounding environment as pure heat just from the natural resistance in the wires. Engineers call it I squared R loss.
And if you're running a hyperscale AI farm, that heat loss penalizes you twice.
Right.
Wait,
First, you're paying millions to the utility company for electricity that is literally vanishing into thin air before it even reaches the processor.
just burning cash.
Literally. And second, you now have to spend an enormous amount of additional electricity to run massive industrial air conditioning and liquid cooling just to extract that waste heat. Otherwise, your million-dollar chips will literally cook themselves.
So the math becomes unsustainable incredibly fast. The industry is being forced into this structural shift. They have to abandon the legacy 54-volt standard and migrate to an 800-volt high-voltage direct current architecture, or HVDC.
And the physics behind HVDC is beautifully elegant. If you drastically increase the voltage up to 800 volts, you can deliver the exact same amount of total power to the rack while drastically reducing the actual current flowing through the wires.
Less current means thinner wiring.
Thinner wiring, smaller components, and most importantly, you virtually eliminate that massive heat loss. It solves the efficiency bottleneck and the thermal crisis all at once.
Okay, so the theory is elegant, but the practical execution is where the industry slammed into a brick wall. Because the obvious question you're probably asking is, why didn't we just use 800-volt architectures a decade ago?
The physical limitations of standard silicon. For over half a century, the entire digital world has been built on traditional silicon chips. It's cheap, it's abundant, it's reliable.
But it has an atomic limit.
It does. When you subject standard silicon to extreme high voltages and high temperatures, it fails. If you try to force 800 volts through a silicon power transistor at the blistering switching speeds an AI data center needs, the material leaks power, it generates massive internal heat, and eventually the atomic structure just breaks down and shorts out.
So traditional silicon is physically incapable of handling this 800-volt transition.
Correct. It just can't do it efficiently.
And that specific failure of silicon is the catalyst for this entire deep dive. It opens the door for a new class of materials known as wide-bandgap semiconductors, specifically Silicon Carbide, which is CSE, and Gallium Nitride, which is GaN.
Right.
Now, wide-bandgap sounds like deep engineering jargon that you usually just gloss over in a white paper. But if you want to understand where the hardware market is going, it's vital. Can you give us the explain it like I'm five version of what a wide-bandgap is?
Sure. Think of the atoms inside a semiconductor as having different energy levels or lanes on a highway. The band gap is the physical barrier, the median between the lane where electrons are tightly bound to the atom and the lane where they are free to move and connect electricity.
Okay, I'm with you.
In traditional silicon, that median is very narrow. It doesn't take much voltage or heat for electrons to jump across. That's great for low-power consumer electronics. But hit it with 800 volts in a hot data center, and the electrons start jumping uncontrollably. The material loses its ability to cleanly switch power on and off.
It just becomes chaotic.
Exactly. Now, wide bandgap materials like silicon carbide and gallium nitride have a much wider barrier. It takes significantly more energy to excite those electrons. In practical terms, this means you can hit a GaN or SiC chip with massively higher voltages, run it at blistering temperatures, and switch the current on and off millions of times a second without any degradation.
So they're basically a heavily armored, supercharged version of silicon.
That's a great way to put it, yes.
And the historical perception of these materials has totally flipped. Not too long ago, GaN and CC were viewed as like niche premium upgrades. You'd throw a GaN chip into a high-end laptop charger to make it smaller, or put CC in a luxury EV for a few extra miles of range.
But today, because of that 1 megawatt server rack reality, they aren't luxury upgrades anymore.
No, they are baseline critical infrastructure.
Yeah.
They are the physical prerequisite to make AI data centers economically viable. If a hyperscaler tried to build an AI facility without them, the sheer electricity required just to run the cooling would completely obliterate their profit margins.
So the macro reality is firmly established. AI is consuming tech. AI needs power. Power needs 800-volt architecture. And 800 volts fundamentally requires gallium nitride and silicon carbide. Period.
The causal chain is unbroken. So let's transition our focus from that broad theory down to the specific micro-execution of Navitas Semiconductor. They are attempting to position themselves as the toll booth on that exact sequence of dominoes.
And to evaluate if they can pull that off, we have to dissect their recent financial performance. Because a superficial glance at their headline numbers from late 2025 might trigger some immediate alarm bells.
Oh, the shock factor on the top line is undeniable. Let's get into the actual numbers from their recent filings. For the fourth quarter of 2025, Navitas posted total revenue of just $7.3 million. And for context, just one quarter prior in Q3 2025, they brought in $10.1 million. Look back a full calendar year to Q4 2024, they were generating $18.0 million.
So you're looking at quarterly revenue collapsing by more than 50% year over year.
In normal public market conditions, usually signals a company in a death spiral, losing massive market share. So why would a company intentionally tank its own revenue stream like this?
Because it's a story of calculated, aggressive corporate restructuring. Management essentially decided to burn the boats. They looked at the macro landscape and made the agonizing, intentional decision to walk away from the market that originally put them on the map.
The legacy consumer electronics space.
Yes. Specifically, the China mobile market, the chips that go into fast chargers for smartphones and tablets.
We really need to unpack the psychology and economics of that fast charger market. Navitas achieved massive scale there. They shipped hundreds of millions of GaN units. But the reality of consumer electronics, especially in the Chinese supply chain, is brutal.
It's hyper-aggressive pricing wars.
Insanely short product life cycles. A design is obsolete in 6 months, and the profit margins are razor thin. You are fighting tooth and nail over literal pennies on every unit. The executive team realized keeping their focus there was a strategic dead end.
It was tying up their top-tier engineering talent and occupying valuable foundry capacity.
Exactly. And it was burning operational bandwidth on low-margin goods, preventing them from really attacking the AI supercycle. So they accepted the brutal short-term optical hit to their top-line revenue to free up resources for high-power, high-margin enterprise applications.
And internally, they call this transition Navitas 2.0. Now, Q4 2025 looks optically horrific to an algorithm screening for growth, but institutional analysts largely interpret that $7.3 million mark as the absolute trough of the transition. The bleeding has stopped.
You can see the rebound materializing in the Q1 2026 outlook. Management guided for sequential revenue growth, estimating between $8.0 and $8.5 million for Q1. And they project steady sequential growth throughout the 2026 fiscal year as new high-power design wins enter mass production.
But the most critical piece of data confirming this pivot isn't the total revenue number itself, it's the internal composition of where the money is coming from.
The revenue mix.
Right. Q4 2025 was a massive milestone. For the first time in company history, high-power markets represented the majority of their quarterly revenue. The mobile fast charger sector shrank to account for less than 25% of their total business.
That specific metric proves the Navitas 2.0 strategy isn't just empty corporate speak. It's showing up in the audited sales data. They are successfully replacing low-margin consumer revenue with high-margin infrastructure revenue.
But transitioning a product line is only half the battle. The other half is survival. You can't watch your revenue get cut in half and maintain your historical spending, or you'll incinerate your cash reserves.
Right.
Navitas implemented severe financial discipline here. They executed an aggressive cost-cutting program, slashing their operating expenses by 24% year over year. They compressed their non-GAAP operational expenses down to roughly $15 million per quarter.
And I want to translate that for you because lowering the EBITDA break-even point gets thrown around a lot in these turnarounds. By cutting operating costs to $15 million, while holding non-GAAP gross margin steady at around 38.7%, Navitas fundamentally rewired the mathematical engine of the company.
They don't need to hit historically high revenue targets just to stop bleeding cash anymore.
Exactly. Because core expenses are lower, Every new dollar of revenue pulled in from these lucrative AI contracts drops straight to bottom-line profit much faster than it ever did before.
And the ultimate arbiter of success in a valley of death transition like this is the balance sheet. When revenue falls 50%, the assumption is a liquidity crisis, bankruptcy, or toxic dilutive financing.
But they neutralized that risk completely. In November 2025, they executed a private placement, raising $95.6 million in net proceeds from institutional investors.
A raise of that size right before an ugly earnings report tells you exactly what institutional capital thinks about the long-term play. They handed Navitas nearly $100 million because they see the 800-volt architecture shift.
And the result is the ultimate de-risking factor. Navitas closed out the 2025 fiscal year sitting on a fortress balance sheet of $236.9 million in cash and cash equivalents, with zero debt.
Zero debt in this interest rate environment is a massive strategic advantage. It guarantees their survival. They have the hard capital to fund R&D, build supply chain partnerships, and absorb near-term losses without the threat of insolvency.
And that cash pile is exactly how Wall Street is viewing the 2027 projections. Analysts are modeling a massive institutional bull case for 2027, projecting a 79% revenue surge that would take the top line to approximately $95 million.
That acceleration is tied directly to the timeline of mass production scaling up for NVIDIA and other hyperscalers.
You have to balance two realities here. The short-term pain is highly visible, widening net losses as they absorb the pivot costs. But institutional capital is weighing those near-term losses against the asymmetric upside of dominating a trillion-dollar infrastructure upgrade.
So with that fortress balance sheet securing their survival, the obvious question is, what exactly are they building with all that cash?
Let's transition to the technology and the strategic moves driving Navitas 2.0. The philosophy is clear. Abandon phone chargers, focus entirely on high-power sectors with multi-decade runways, AI data centers, electric vehicles, performance computing, and the renewable power grid.
The serviceable available market, or SAM, that they are targeting is projected to reach $3.5 billion by 2030. And between $1.4 billion and $2.5 billion of that is expected strictly from AI data center power components.
That contrast shows exactly why they endured the pain of leaving mobile. The ceiling in infrastructure is exponentially higher, and the design win life cycles last for years. But to capture that market, you need hardware that alters the economics of the industry.
Extreme energy efficiency. The hyperscalers are desperate for green infrastructure solutions.
Let's look closely at their latest breakthrough from the recent reports. Navitas unveiled a 10-kilowatt 800-volt to 50-volt DC-to-DC power platform. And the spec that grabbed everyone's attention is the efficiency rating. It delivers an industry-leading 98.5% peak efficiency.
We really need to unpack the math behind 98.5%. Because to someone outside power electronics, it might sound marginal. If an older silicon system operated at 95% and the new GaN system is at 98.5%, a layman might say, it's only a 3.5% difference. Why rip up the floorboards for that?
You have to invert the metric. Don't look at the efficiency, look at the loss. If your legacy system is 95% efficient, you are actively losing 5% of your massive power draw as pure heat.
Exactly. Now look at the Navitas platform. At 98.5% efficiency, you are only losing 1.5% as heat. You didn't just improve by 3%. By moving from a 5% loss to a 1.5% loss, you successfully eliminated more than 2/3 of the total heat generated by the server rack.
And when you apply that to a 1 megawatt rack running continuously, reducing heat output by over 66% completely alters the facility's economics. It eliminates the need for millions in supplemental liquid cooling. It frees up real estate. It lowers the power usage effectiveness of the whole building.
That 98.5% rating is the foundational metric that makes an 800-volt AI factory physically possible to operate at scale.
And the ultimate validation came recently from NVIDIA themselves. Navitas was officially recognized as a designated power semiconductor partner for NVIDIA's next-generation 800-volt direct current AI factory architecture.
Being tapped by NVIDIA instantly validates the corporate pivot. As part of this, Navitas is deploying their new 650-volt and 100-volt GaN-fast FETs.
Quick translation for you listening. FET stands for field effect transistor. It's basically a microscopic switch turning current on and off, but why does the GaN-fast branding matter here?
It refers to their proprietary integration technology. In legacy systems, the GaN switch, the driver controlling it, and the protection circuits were all separate components on a board. Navitas figured out how to integrate all of those functions into a single, unified gallium nitride chip.
Monolithic integration.
Right. It means the switch can turn on and off millions of times per second with virtually zero delay or signal interference, which is exactly what NVIDIA needs to manage power dynamically.
Securing that NVIDIA partnership is huge, but it introduces incredible pressure to manufacture these chips reliably by the millions. And this brings us to a massive unfolding drama in the global supply chain.
The TSMC exit.
Yes, Navitas designs the chips, but they rely on foundries to print them. And TSMC, the world's largest foundry, recently dropped a bombshell. They are entirely phasing out their gallium nitride manufacturing operations by July of 2027.
The magnitude of this shock cannot be overstated. TSMC walking away from GaN just as the supercycle accelerates seems counterintuitive. But they are making a ruthless allocation of finite resources. They face intense price competition and low-end wide-bandgap from subsidized Chinese fabs, suppressing margins.
And simultaneously, the AI explosion created an insatiable demand for advanced packaging technologies, specifically CoWoS, or chip-on-wafer-on-substrate. We can't shrink transistors indefinitely, so we have to build vertically. CoWoS is like building a high-rise apartment complex for chips instead of a sprawling suburb. You pack components incredibly close on a single substrate to increase speed and reduce power.
And building those microscopic high-rises requires immense capital and factory floor space. TSMC looked at the low margins from printing GaN and decided to tear out that equipment to make room for lucrative CoWoS packaging lines for clients like NVIDIA and AMD.
They are executing their own pivot. But for Navitas, this is a potential existential threat. Navitas is currently TSMC's largest individual customer for GaN, and that assembly line shuts down in less than 2 years.
So how does a fabless company survive losing their primary manufacturer? Navitas is executing a highly complex foundry migration strategy. They are transitioning away from TSMC and building deep long-term partnerships with PowerChip and global foundries.
Which is notoriously difficult. You have to requalify the entire manufacturing process, adjust microscopic designs to fit new equipment, and endure heightened execution risk.
The global foundries partnership is particularly fascinating because it intersects with macro geopolitics. GlobalFoundries is utilizing over $80 million in U.S. federal funding to build a massive, dedicated 200-millimeter GaN-on-silicon manufacturing hub in Burlington, Vermont, targeting late 2026 availability.
The location is a critical piece of the puzzle here. Look, reporting impartially on the U.S.-China trade relations and tariff dynamics, the U.S. government is actively deploying capital to incentivize domestic manufacturing to reduce reliance on Asian foundries.
Right, for supply chain security.
Exactly. Shifting massive production to U.S. soil in Vermont directly insulates Navitas from potential future tariff shocks or disruptions in the Taiwan Strait. It aligns perfectly with the U.S. mandate for domestic supply chain resilience.
Establishing a fully qualified domestic supply chain is a massive de-risking event. By securing capacity at global foundries, Navitas finds a permanent home post-TSMC and uniquely positions themselves as a secure, domestically sourced supplier.
Which is an absolute prerequisite for securing massive long-term contracts with U.S.-based hyperscalers or lucrative government and defense projects. The migration carries near-term risk, but if navigated successfully, it fundamentally strengthens their long-term competitive moat.
And up to this point, our discussion has been heavily anchored to the AI data center narrative, but Navitas 2.0 is broader than just AI. We need to look at how they are actively re-architecting the global power grid itself.
Yeah, as the economy aggressively electrifies, transitioning to EVs, heat pumps, digitizing heavy industry, the legacy electrical grid is buckling. Navitas is making a calculated push into solid-state transformers, or SSTs, leveraging their ultra-high voltage silicon carbide modules, specifically the 2300-volt and 3300-volt variants.
To grasp the revolutionary nature of an SST, you have to understand the limitations of the hardware it replaces. Traditional transformers, the bulky, oil-filled metal canisters on utility poles, that technology has barely evolved in over a century.
They rely on massive copper coils and iron cores.
They operate on low frequencies, they are incredibly heavy, and crucially, they are analog devices designed for a one-way street, taking high voltage power from a central plant and stepping it down for your house.
But the modern grid isn't a one-way street anymore. If I put solar panels on my roof, I'm generating DC power that needs to flow backward into the grid. If I plug in an EV, the charger pulls massive spikes of power, converts it, and pushes it into the battery.
Analog iron cores were never designed to handle that dynamic bidirectional traffic efficiently. Solid-state transformers replaced those heavy copper coils with high-voltage semiconductor switches, which is where the 3300-volt C modules produced by Navitas come in.
By digitizing the transformer, you reduce its physical size and weight to a fraction of the legacy equipment. You increase the efficiency. But most importantly, you make it smart.
Exactly. An SST can actively manage bidirectional power flows. It can seamlessly balance the intake from a local solar farm with the sudden massive draw of a commercial EV fast charging station. The 3300-volt CC chip is the digital brain, allowing the grid to handle the extreme volatility of modern electrification.
And the financial opportunity here is staggering. Internal estimates project an addressable opportunity of between $25,000 and $35,000 of Navitas Semiconductor content per individual megawatt deployed in these grid applications.
When you consider the hundreds of gigawatts of new clean energy and grid modernization projects mandated over the next decade, that represents a massive multi-decade revenue pipeline totally independent of AI or consumer electronics.
It perfectly encapsulated the dual nature of their pivot, capturing the explosive hypergrowth of AI data centers with GaN while embedding high-voltage SATE into the foundational upgrade of the global grid. So pulling all these threads together, what does this actually mean for you listening?
It means the true narrative of the semiconductor supercycle extends far beyond the companies designing the AI processors. The companies designing the advanced power delivery networks are undergoing a massive renaissance of their own.
The story of Navitas is one of a company willfully enduring acute short-term financial pain, burning their own boats to secure a position in a trillion-dollar infrastructure upgrade. But before we wrap up today, there is one final provocative thought we want to leave you with.
It ties directly back to that supply chain shock. TSMC exiting GaN manufacturing is forcing every fabless power chip design company into a highly complex, expensive foundry migration process.
Navitas can navigate this because they aggressively raised capital. They have a $236 million fortress balance sheet. They can afford the engineering hours and CapEx to secure dedicated space at global foundries and power chip.
But what happens to the rest of the market? What happens to the smaller power chip startups attempting to break into this space who do not have $250 million in the bank?
It's a phenomenal question. Could this massive supply chain shock actually end up constructing an impenetrable competitive moat for Navitas? By the time the dust settles in 2027, the barrier to entry for manufacturing wide-bandgap components at commercial scale might be so astronomically high that smaller competitors are simply starved of foundry capacity and wiped off the board.
A severe near-term industry crisis could calcify into a massive, insurmountable long-term advantage for the companies with the balance sheet to survive it.
We hope you enjoyed this deep dive, and thanks for listening. Please follow us and subscribe on your favorite platforms. Don't forget to check out our Substack, Delta Investments. Until next time.
This analysis is based on publicly available information and does not constitute financial advice. Always conduct your own research before making investment decisions. By listening to this podcast, you agree that you are in charge of your own decisions and risks, and that you are solely responsible for any investment decisions you make.